Welcome back guys, it's the Foolish Investor coming back to you with another hopefully not too foolish video. And as always, you guys know, I hope you find something useful, helpful and informative in this video. So I know it's been a little bit of a difficult week in the markets. Markets have been suffering, but I thought it was a good time to kind of get away from those distractions and start to focus a little bit more on helping you guys figure out how to analyze companies. So I know a lot of people have been asking questions about how to kind of analyze companies, what kind of things you should be looking for. So in this video, I'm going to walk you through this kind of checklist which can basically help you figure out whether a company is investable before you make a decision about investing into it. So if you guys are looking forward to this one, if you're interested, make sure you do stick around. As always, I hope you guys are going to enjoy this one. So guys, let's get straight into this one. So like I said, we're going to go through some of these kind of factors, this checklist of some of the things which are really important in my opinion to consider when assessing whether a company is possibly a good investment. So you go through all of this checklist and then you kind of get a score at the end. And if the company is above kind of your minimum threshold score, then you can possibly consider that that company could be a good investment. And then you can go on to have a look at things such as a valuation. But let's have a look. So one of the first things that you always want to consider are the financials. Really important for any business. They need to have good financials. So one of the first factors that I'm looking at is financial resilience. Now, financial resilience, basically you want to address how likely is this company to go bankrupt? How much debt do they have? How much cash do they have? How much do they own? How much do they owe to other people? All the kind of things you want to consider when looking at this. So now to do this, it really isn't very difficult. You can just pull up the SEC filings, quarterly reports, annual reports for any company you're interested in. And then you will just want to have a look at the balance sheet. And you mainly just want to focus on cash and debts. It can be really difficult to get complicated into everything and try to understand everything, but don't think that you need to understand every aspect of that. The main things, like I said, you want to focus on cash, assets and debt, which is liabilities. So you can use a lot of things to find this kind of information. You can use Yahoo Finance. What I like to use is Seeking Alpha. So you can see here, I just click on financial statements. And what I'm looking for is the balance sheet. So I want to see, okay, how much cash does this company have? Now I know that this isn't exactly up to date because the company recently exercised some warrants. So even though it says here 3.2 million in cash, I know the Tattooed Chef actually has around 200 million in cash. So I'm going to keep that in my mind throughout while I'm doing this assessment. So now I know they have 200 million in cash. The next thing I want to look for is their debts. So you look under current liabilities, you can see they've got around $20 million of short-term debts. And then they've got around $2.3 million of long-term debt. So altogether, their debt works out to around $22 million. Now they've got cash on hand of $200 million. So they're easily able to pay down their debt at any time. So I don't see this company getting into any immediate financial difficulties. So for that reason, I give the company a 5 on financial resilience. I just really don't see that this company is going to have any financial issues anytime soon, not enough debt to cause them any issues. And the company is actually profitable, so they should keep building cash as the years move forward. So I give them a 5 out of 5 for financial resilience. Then the next thing you want to have a look at is the gross profit margins for a company. This is really important because it plays into later how much operating leverage the company has, how much cash they're able to generate, how much money they're able to spend on things such as marketing, advertising, acquiring new customers without putting themselves into financial difficulty. So gross margins are really important. And often some of the most profitable companies have very, very high gross margins. So you can see if the company is below 50% margins, you'll give it a 1. If it's between 50 to 80%, a 2. And above 80% is a 3. But Tattooed Chef has a margin of around 35%. Again, you can find that information on these kind of balance sheets. So I'll try and talk you through where to find this information as well as we go through the video, just to help you guys know where to kind of have a look. So you want to have a look at the income statement. You'll see that they have revenues of around 135 million. And the cost of that revenue was around 115 million. So they have a gross profit of 20.6. So if we just do 20.6 divided by 135, you can see the company has around a 15% gross margin. Now that's why you can see here I've given the company a 1 because it's below that 50% that we're ideally looking for when we're considering a company to invest in. Now the Tattooed Chef is a fairly new company and they have their eyes set on getting towards a 35% margin, which will of course be a lot better than this, but currently at this moment in time we give them a 1 for the gross margins. So the next thing that you want to have a look at is the return on capital. So what that basically shows you is for the money, the debt, the equity that the company has, how much money does it generate for all of that money that it puts into its business. And this is this is really important to understand, because if you find companies with high returns on capital, these are the kind of companies that are generating money with the money they put into their business and are able to reinvest into innovation, grabbing market share and fending off competitors. And if you find companies with good high returns on capital, then you're probably going to find yourself a successful investment, because those companies are efficient with money and are generating money for all the dollars that they spend. So I'll quickly show you how this works with the Tattooed Chef, because I want to really break this down to you guys, because these things sound really complicated but they really don't need to be. So having a look at the Tattooed Chef again, the important thing to have a look at is the balance sheet. So what you want to do is come down to the balance sheet and have a look at the equity. So we can see that the company has $7.9 million of equity. And then we also want to have a look at the debt. So we know altogether the debt was around 2.3 million plus 19.7 million. So debt is roughly around 23 million. Equity is around 7.9 million. So altogether we're looking at about $31 million of equity and debt. The next thing that we do need is the net income for the company. So we're just looking at their trailing 12 months, because they've not actually reported their Q4 figures yet. So you can see net income is around $6.1 million. So all we've got to do is take this figure, net income, which is around $6.1 million, divide that by the amount of debt and equity, which was roughly around $31 million. And there you can see the answer there. So the answer is basically 19%. So what that means is that for every dollar the Tattooed Chef invests, it returns around 19% or 19 cents. Now, companies can obviously be a lot higher than this, but for an early stage company, very early in its kind of profitability cycle, I expect this to increase for the company, and this is not very, very bad. In fact, it's actually decent, and therefore we'll give the company for now a figure of around 1, because they're generating 19%, which I think is pretty impressive. However, as time moves forward, we'll keep an eye on this and see if it continues to improve for the company. Now, the next thing you want to have a look at is free cash flow. So how much cash does the company generate from its operations after paying what's known as capital expenditures? Free cash flow, really, really important, because it shows you how much cash the company is actually generating and has available to put back into the business or to pay to you as a shareholder in the form of dividends. So free cash flow, there's no need to get complicated about it. Basically, you can go on Yahoo Finance, you can go on something like Seeking Alpha, look at what is called the cash flow statement. So every company splits its results into income statement, balance sheet, and cash flow statement. And you just come down and you look here and you can see basically levered free cash flow. Just focus on that at the moment. You also get unlevered free cash flow, but even if you just look at this, that's fine. But you can see at this moment in time, the Tattooed Chef hasn't got any free cash flows. So for Tattooed Chef, I'm going to mark this down as a 1 because it's currently negative. I don't want to give it a 0 because the company is very new and I expect it to become cash flow positive soon. So I'll give it a 1 because it's not cash flow positive yet. But cash flow, free cash flow, really, really important, because analysts use discounted cash flow models to get the valuations of companies. So they really hone in on how much cash flow a company is generating, and a company with more cash flow gets higher valuations on Wall Street, and therefore you can generally expect the stock price will move higher with that. So there you go, free cash flow. And the next thing you want to have a look at is the EPS, so the earnings per share. Is this company earning profits for each of its shareholders? So earnings per share is basically the net income of a company divided by the amount of shares it has. So for all the income it has, when you divide it by the amount of people that have shares, the amount of shares outstanding, how much profit goes to each share. EPS is pretty much, in my opinion, the single most important metric for any business, because stock price usually moves with earnings per share. So if a company earns $1 per share 1 year and is priced at 20 times its earnings, its stock price will be $20. If it's still priced at 20 times its earnings next year, but it earns $2 per share next year, you can expect the company to be priced at $4. So just to kind of have a look, one of the places you can see the earnings per share again is on the income statement, but to make it even easier for you, you can literally go on Yahoo Finance and you'll see the EPS listed for companies for this year, for the previous years, and potentially sometimes they'll also show you the estimated EPS for the next year as well. On Seeking Alpha, what you can do is just go on to earnings estimates, and you can see here that analysts basically expect for this year the company should be reporting in a few days from now that the Tattoo Chef will show an EPS of around 16 cents per share. So coming back here, we can see that it's not negative, it's positive. However, I'm going to give the Tattoo Chef a 3 here because the EPS is expected to grow really fast. So you can see here that it's expected to grow up to 32 cents by 2022, 50 cents by 2023, which is like a 276% growth, a fixed 56% growth. So the earnings per share are expected to grow pretty quick for this company. So that's all the factors for the financials. We looked at resilience, gross profit, returns on capital, free cash flow, and earnings per share. So far guys, I hope you're keeping up and you're enjoying the video so far. Now, one of the next things you want to look at, and something that is really important, is a company's moat. What kind of competitive advantages does a company have that protects it from competitors? Now, I think a lot of people forget about this and don't pay too much attention to it, but it's really important, because if you invest in a company that has a game-changing and world-changing idea, but everybody else is just able to copy it, then that company isn't necessarily going to be a very good investment for you. So one of the first things you can look at when considering a moat is something called the network effect. So you can see whether they have a network effect or a product ecosystem and rank it based on it not having any, being weak or being strong in this area. So a network effect, basically all it means is that the company's product or the company, the way it works is that the more people that use the system, the stronger the network kind of grows. So one of the examples of this is something such as Amazon. So it has really strong network effects. So the more sellers that list their products on Amazon, the stronger the platform gets, and the more people then come to use Amazon, the stronger the platform gets. And it becomes kind of a cycle. If there's more sellers selling things on Amazon, then you have more customers using Amazon, and the more customers that use Amazon, the more sellers want to come to Amazon, and vice versa. So it's like really strong network effects. The more people they have using the platform, the more sellers they have wanting to sell on the platform, and the more sellers they have with a variety of products on the platform, the more people then want to come on and start shopping on the platform. So that's basically what's meant by network effects. Another thing you can look at is product ecosystem. So a company such as Apple is a really good example. So they have their phone, but they have a whole ecosystem with chargers, with headphones, with Apple Pens for their iPads. So it's a really big ecosystem. So these are kind of the things that you kind of want to see. One of the things you want to see as a moat for a company. Now for the Tattooed Chef, unfortunately, I don't think they have a very big moat in terms of network effect or product ecosystems. It's more possible that they might develop a bit of a product ecosystem if they're kind of able to develop their range of products into away from just frozen foods into everything, such as snacks, such as drinks. So there's a lot of verticals the company could extend itself into, but at this moment in time, I'm only giving it a 5 out of 15. It doesn't have the best kind of moat in this sense. So the next thing you want to have a look at is switching costs. So would it be very costly for the company to have to move away from using, for customers to have to move away from using this company and then go to moving and looking into using another company? So for example, if you want to personally change your internet provider, it's not that difficult. You don't have that many costs associated with it. However, if a company such as Splunk provides a software service that's integrated to large companies' internal systems, it might cost a very big amount of money for a customer to move away and use a competitor's product. Now, Tattoo Chef is a 0 here. It doesn't have any kind of high switching costs. You can walk in and pick another brand's food at any point of time. So no moat there for the Tattoo Chef. Another thing then to consider is, does the company have a durable cost advantage? Is it consistently, because of a variety of factors such as the scale, distribution it has available, its location, or vertical integration, able to have a durable cost advantage versus competitors? So can it always just price itself more competitively than its competitors can? Now at this moment in time, I'm not going to say the Tattooed Chef has this, but I do think it's possible they could develop this because they have what's known as vertical integration and also scale available to them. But this vertical integration is very applicable here because they do everything in-house, starting from planting their own vegetables for the food and manufacturing it all and doing the whole process themselves. So I'm not going to say 0, but I'm going to give them a 5 for now, and we'll see if this develops into more of a moat moving forward. The next thing you want to have a look at is intangibles. So for example, does the company have a premium brand? Sometimes that's all that's needed for a moat. So Nike doesn't necessarily have to worry about people coming out and selling cheaper clothes than them, because Nike has a very huge moat in its brand. It's a well-loved, well-known, well-recognized brand, and that's a very huge moat for them, and it protects them from competitions. Other moats can be patents. So if you have patented technology, then that can also be a moat because people can't just copy the technology you've got. Now in Tattooed Chef's case, they have a brand, but the brand is really unknown at this moment in time, but they have the potential to develop it into one which protects them from competitors. So again, out of a scale of 15, I'm only going to give them a 5 here. The next thing you can look at is, would it affect competitors badly if they had to adopt a similar model to your company? So the company you're looking at might offer a software as a service subscription model. If their competitors had to emulate that, would it really harm their business? Would it take them a long time? Would it cost them a lot of money to implement that switch? With the Tattooed Chef, again, not too much of a moat here in that sense. It's not really going to affect a company too much to kind of copy their model of making plant-based food. The next thing you want to look at is the direction of the moat. So having considered all of this and saying whether either the company has a moat or doesn't have a moat, is the moat growing? Is it getting smaller? Is it stable? And then you just kind of rate that out of 5. So you can see here again for the Tattooed Chef, I'm giving it a 1 because to begin with, the company doesn't have much of a moat to begin with. And that is one of the concerns and one of the weak points of this investment in Tattooed Chef. As much as I love the company, is something that I always am concerned about with them because they don't really have a moat unless they effectively build their brand out to become a household name and become the first choice for plant-based food. It's always a worry that other competitors could just come along and make similar or same products to them, and therefore the company isn't very well protected in terms of a moat. So a bit of a downside for the Tattooed Chef. So having looked at financials, having looked at the moat, one of the next things to consider is the company's potential. So a really cool thing to look at when considering potential is optionality. So can the company get into a lot of different verticals? Does it have a lot of different options in different products, different customers that it can target? And you can see I've given the Tattooed Chef a 7 out of 7 here. So you can see that if the company has no optionality, you'd give it a 0. If it's got optionality within its own kind of industry, you can rate it a bit higher. And if it's got optionality in newer industries, you can rate it even higher than that. And by new industry, what I mean is the Tattooed Chef can really expand its products away from the frozen food aisle. They can get into desserts, they can get into snacks, they can get into drinks, they can get into pretty much anything plant-based which fits with their model. So I think the company has a huge amount of optionality in front of them, and that really extends their potential. Then you want to consider the organic growth runway. Can this company continue growing for quite a long time at quite a fast pace without having to acquire other companies? So some companies, when they get quite big, such as Microsoft, such as Apple, start to kind of consider looking for companies to acquire because it's not that easy for them to grow their revenues that much more organically. Now the Tattooed Chef I've given a 4 out of 4 because I expect this company to be able to grow incredibly fast for an incredibly long period of time. The company is in a very new industry, a growing industry in kind of the plant-based healthy food space, and that industry has a long way to grow and is expected to grow a lot in the next decade and the years after that as well. Next thing you want to do is consider, is this company a top dog in either an important industry, an emerging industry, or is it a complete entire industry disruptor? So an example of a top dog in an important industry could be a company that is a leader in the industry of something such as mobile phones. So you've got Apple, which is a top dog in mobile phones. You could have a company which is a leader in an emerging industry, and that is where you can look at something such as the Tattooed Chef. Plant-based food and the popularity of it is very much an emerging industry, and this company is kind of basically showing a new way to do it. So I give this company kind of a 2 out of 3. I don't call it an industry disruptor. For industry disruptors, you're looking companies more like Tesla and Uber. So Uber didn't create a new industry. It just tapped into the industry of the taxi network and completely disrupted that industry. Another example is Tesla. It wasn't exactly creating a new industry. Vehicles have always been sold for a very long time, but it created an entirely new way to do so. So in this scenario, I give Tattooed Chef a 2. It's not a top dog, but it is a fast growing player in what I describe as an emerging industry. So now we've considered 3 kind of factors. We've looked at the moat, we've looked at the financials, and we've looked at the kind of potential the company has moving forward. Now we want to look at their relationship with customers. So what we want to see is, in terms of acquiring customers, how much is sales and marketing as a percentage of their gross profit? Do they have to spend almost all their money on acquiring new customers? And some businesses do need to do that. So you see really high revenue numbers and you think, wow, the company is doing really well. But if they're spending 70% of that just to acquire the customer in the first place, then that business is really going to struggle to be profitable. So if you want to see basically is sales and marketing, what percentage of gross profit is that? Is it less than 50%? Is it less than 10%? And you want to rank it accordingly. As I mentioned, the Tattooed Chef had really low sales and marketing costs. They don't spend that much money when it comes to marketing, and that's why I'm giving the company a 5 here. Another thing you want to have a look at in terms of customers is acquiring their customers very dependent on certain factors? So is it cyclical? Do customers only come around at certain economic cycles? Is it moderately dependent on the economy? Or is it recession proof? So really, ideally, you want to be invested in a company which is recession proof. And I give Tattooed Chef a 4 out of 5 here because a company because they're based in food, generally they shouldn't be too affected by a recession. People are always going to want their food, and although the Tattooed Chef, and the reason it's a 4 out of 5 is the food is quite expensive, so in a recession they may see a little bit of a hit on sales, but I wouldn't expect it to be too large because, like I said, people need to eat, and especially for people in the vegan space, they don't have the widest amount of options. However, it's possible people might switch to cheaper brands even if they don't like those brands as much. So we'll give it a 4 out of 5. But generally, I think the company isn't too dependent on how well the economy is doing. Now, these factors here, they don't really factor into the score, but just something to keep into your mind. So one of the things you want to have a look at is customer reviews. Are they good? And I say the Tattooed Chef has sublime reviews. You can do this by just looking at Google listings, their social media pages, their websites where their products are stored. So just kind of find yourself customer reviews for the companies. Then the next thing you want to ask yourself is the brand or service synonymous with the product? So an example of this is Airbnb. Airbnb is synonymous with its product. People don't necessarily say they're booking a room, they say they're booking an Airbnb. I don't think the Tattooed Chef is at that stage yet, and I don't really think it's going to be, so I'm going to put that as a no. But this is something you want to look at when investing. If you find companies that are synonymous with their products, a lot of the times these companies go on to be hugely successful. Another example is Zoom, and you all know how that company's performed this year. Then the next thing you want to do is a snap test. So if this company was to disappear within a second, if it disappeared tomorrow, will people really notice whether it's not there? Is this company and its product good for customers? Now, an example of this, for example, is Apple. If people's phones just disappeared from their lives tomorrow, of course people are going to notice. But not every product fits into this category. However, with the Tattooed Chef, I think the fact that they service a community which is currently underserved, being people who are vegan or vegetarian, I think those people are going to notice if this brand disappears. People really like the company's food. They like the fact they get to have things that they might not have been able to eat before. And the product is actually good for the customer. It's healthy, organic, GMO-free food. And it gives customers an option to just widen their kind of ready meal availability because they're able to find these plant-based options. So This one I find really important. Ideally, you really want to find a company that passes the snap test. Now, some other factors which can help boost the score of a company is, does it have recurring revenue? Now, the Tattooed Chef isn't some kind of SaaS company, so it doesn't really have that, so it's a no from here. But when you're looking at certain companies, you want to see, do they have recurring revenue? So one of the other companies I mentioned on the channel a few times is T-Doc. That company has around 78% of its revenues as recurring revenue, and the reason recurring revenue is so good is it normally brings in higher gross margins, and it gives you some kind of visibility into future revenues for the company. Because it's recurring, you can assume that if customers stay on board, this is how much money they'll make next year, and this is how much more they'll make if they acquire this many more customers. But again, in the Tattooed Chef case, it's a zero here. You also want to consider pricing power for a company. So is the company in a position where it's able to price its product as it kind of sees fit? So an example is someone like Apple. They can increase the price of their phone by $100 and people will still buy the phone. Now, really important, because what it means is the company can always kind of protect its profit margins. If a company has no pricing power, if there is tons of competition and the company doesn't have any kind of moat or any kind of brand or USP which allows it to price its products higher than its competitors, it can often become a race to the bottom, and a very big industry and a potentially successful company can become a failed investment because they're just never really able to become profitable. So the Tattooed Chef, I give it a kind of 2 out of 5. The way I think about it is that at this moment in time, the company doesn't necessarily have huge pricing power. It does to a degree because it's in a niche market and the amount of products available to people in that market isn't very high, so they have some level of pricing power. But if this brand really develops into a household name, which I think it has the potential to do, they haven't got there yet, then maybe they could really get to that kind of 4 or 5 star rating in terms of pricing power. If they become so well known for their food that they're able to price it like Coke can price their Coke much higher than a generic Coke and people still buy it, then we'll give it a 5. But for now, it's a 2 out of 5. But that's the kind of ways you need to think about some of your companies. Now, I know this video is getting a little bit long. I hope you guys are enjoying it. I hope you're finding it useful. It is a lot of things to kind of go through when assessing a company. It's just really important stuff to consider. Now, when uploading this video, I know that because it's not current news, like some of the stuff we've been talking about recently, I might not get as many views on this video, but really I wanted to do this for you guys who follow the channel, who are subscribed, especially you guys who have that notification bell enabled, who will see this video, and hope you guys do find it useful. So yeah, I just hope you guys find it useful. So I'll carry on. There isn't too much longer to go. Like I said, I hope you're finding it useful. So all of this stuff, looking at the company, really important. Then something else that's really important is the management and the culture. So what you want to see is what's termed here as soul in the game. Does the company have what is called soul in the game? Is the people at the top of the company passionate about the company? And this is so important because realistically, it's passionate people that drive businesses to immense success. So a lot of businesses can be mildly successful, but the businesses that become hugely successful have passionate people running them. One example is Elon Musk. He has literally ensured that through blood, sweat and tears that Tesla becomes a dominant force in the automotive industry, and passionate leaders have the ability to do that. So what you can do to assess this is the company founder run? Is it family run? Or does it have a CEO who's been there for a really long time? You can see I've given the Tattooed Chef a 4 out of 4 here. The reason is that the company is run by Sam Galletti. One of the key members is his daughter. Sam owns a large portion of the company's shares. I think he actually owns almost 40% or more of the company's shares. And there's family, Galletti family is basically running this business together. So there's soul in the game. I'm sure that this family, this father and son, want to see this business succeed. And so much of their personal wealth is tied up in this company with those kind of shares. So I'm sure that these guys want to see the company succeed. Really important to kind of have a look for this. So the next thing is inside ownership. So like I said, Sam Galletti has a high percentage of the shares of Tattooed Chef, and what that basically means is that if the person running the company or people working for the company own a large part of the shares, you can kind of imagine that they are going to want to make the company successful because their own personal wealth is tied up into it. If millions of his net worth is tied into the tattooed chef, he's going to want to see that share price go up. So your interests and his interests are aligned. So always do try and look for insider ownership and try and see that the people at the company are motivated to make sure the company performs well. Now, something else you can look at is more around the culture of the company. So you go on something such as Glassdoor and you have a look at the Glassdoor ratings. So if you have a look at a company such as Apple, you can see that it has a 4.3% rating. 85% of people were happy to recommend working at Apple to a friend, and 95% of the people that reviewed it also approved of the CEO Tim Cook. So you do want to have a look at these Glassdoor ratings. A lot of people don't consider these things as important, but if a company's staff are happy, if the company has a good culture, if people enjoy working at the company, they're gonna basically help that company continue to grow. Now, I've given the Tattooed Chef I'm going to give it a 0 here, not because it's got bad ratings, but just because it's such a new company, it doesn't actually have any ratings at this moment in time. So we'll give the Tattooed Chef a 0 for now. And the next thing you want to have a look at is the company's mission statement. So this again goes into its culture. Is the mission statement really complicated and hard to make sense of, or is it simple, inspirational, optionable? And I like the Tattooed Chef's mission statement. So they basically call themselves a company making plant-based food for people who give a crop. Very simple, but in all of the company's messaging, it's all about healthy, organic vegetable food for people who want to basically care about animal ethics, want to have good healthy food. I think the mission statement is great, and I think it's going to translate really well to their customers and their target audience. So management and culture aside, one of the next things you can look at is the stock price of the company. Now some people have this theory in stocks that winners tend to continue being winners. So you want to see if the company has performed quite well in the past 5 years, or since its IPO. Has it outperformed the S&P? Has it outperformed it by a small amount or by a large amount? So far the Tattooed Chef has performed pretty well, so I'll give it a 3 for now. Now all of these things are not as important as the other things we looked at. These are just some kind of side factors that you can consider. Has the company performed shareholder friendly actions? So have they been paying down debt? Have they been giving out dividends? Are they doing share buybacks? All things that basically help shareholders. Now with the Tattooed Chef, I've given them a 1.5 because I was quite impressed with the way they exercise their warrants. They exercise them in such a way where it caused less dilution to shareholders than it potentially could have. And that was really impressive to me and showed me that the company seems to really value its shareholders. Then you can kind of consider, does the company consistently surpass expectations? So analysts set estimates every quarter, every year for a company. Does the company come in and beat them on a regular basis? For the Tattooed Chef, we don't have much to have a look at because it only sparked this year. But already they've beaten the analyst consensus estimates on their Q4 revenues, so that's good. So I'll give it a 1 out of 4. As time moves on, we can update this. But for some companies who have been reporting for a long time, you just want to look at, have they regularly beat their earnings estimates? You can again do that on somewhere such as Seeking Alpha. So there you've kind of considered all of your kind of fundamental factors when looking at a company. Now, like I said, this is not an extensive fundamental analysis, how to really look into the sheets and do all of that kind of stuff, but it is kind of a basic checklist you can follow of some of the key things to explore and think about when assessing whether a company might make a good investment. Now here, what you've got listed under Gauntlet is basically some kind of wildcard factors to consider about a company, and these kind of factors can either throw up big red flags or just tell you that everything seems to be okay. So first thing is accounting irregularities. I wouldn't concern yourselves too much with that if you don't really understand how to go through the sheets, but for now I'm giving the Tattooed Chef a no. I haven't seen any issues with that. Then what you want to look at is customer concentration. Is the company having 20% of its revenue coming from a single customer? Now, any company that's got more than 20% of its revenues coming from just one customer is a little bit of a concern, because if that company was to lose that customer, it could really impact revenues. So an example of this was Fastly. You might remember when TikTok was banned by Donald Trump, and Fastly lost the revenue from TikTok. It caused a massive hit to Fastly's share price because people were worried where they were going to make up that 10-11% of revenue from. So with the Tattooed Chef, I've put a 3 rather than a 0 or a 5, just because they're kind of concentrated at this moment in certain grocery store outlets, and if they were to lose some of these, it might cause a bit of an impact for the company. I don't expect it to, but just to be conservative, we'll say that's a tiny bit of an issue with Tattooed Chef. Now, is their industry likely to be disrupted? So, for example, pharmaceutical chains might worry about this. Maybe the industry gets disrupted by someone like Amazon with online pharmacy, and that's a bit of a risk for certain companies. You need to ask, can that industry, or is it likely to become disrupted? Tattooed Chef, I can't see any industry disruption for the food industry. Is the company at a big risk of outside factors? So you want to say, are they going to be affected if the price of commodities, copper, steel? So this might be more applicable to companies in manufacturing. Will it affect their business? Will they be highly affected by rising interest rates? So that might apply to banks and mortgage lenders. And are they highly dependent or affected by the economy? So again, for Tattooed Chef, I don't think any of this is a big issue. Another thing you want to consider, is the company a big market loser? Has it lost to the market by more than 50% in the past 5 years? Now again, this is not a key factor. Some companies' stock will perform really badly. It doesn't mean the company is a bad investment, but sometimes it can just be a good indicator of how the market feels about a company. Is the company prone to being affected by a binary event? So if they were to lose a patent appeal, if they were to have a legal ruling change, would it hugely affect the company? So an example of this is Uber. So had California voted that Uber has to class all of its drivers as employees, that could have a huge effect on the business. So something to consider when you're investing. Is the company growing a lot due to acquisitions? So you want to have a look at this. You want to see generally that your company is growing organically and able to without having to acquire companies. So again, Tattooed Chef, no acquisitions. The company is growing all by itself so far. Are the financials complicated? Again, I wouldn't worry too much with this kind of stuff, but if you can't understand where the company makes money from, how it makes a profit, it's a little bit of a red flag as well, potentially. Then is there any monopoly issues? So is the company at risk of being broken up by the government? So you've seen recent issues with companies such as Facebook, Google, Amazon, with the US government potentially going after these companies for having a monopoly. So something to keep in mind when looking at your companies. I can't imagine the Tattooed Chef ever being accused of having a monopoly on cauliflower cheese pizza. So I'm going to give that a 0 for now. The next thing to have a look at is it based or does it earn a lot of its revenue from a high risk country? So that can be a really big risk factor for a company. For the Tattooed Chef, again, a no. And then you want to look at currency risk. So if 75% or more of the company's income comes in foreign currency, that could be a bit of a red flag and a bit of a worry. If there's ever to be a bad currency rate from the US to another currency, it could really affect that company's income. So Chinese companies at the moment, such as Neo, Li Auto, Xpeng, are going to actually report lower figures than they would have a few weeks ago because the dollar isn't doing too well at this moment in time. So because they earn all their money in RMB, they have to convert it to US when reporting those figures. And if there's a lot of currency volatility, it can affect the kind of revenue and earnings figures that the companies post. So again, something to bear in mind when looking at a company. But that's just kind of a simple checklist, not so simple necessarily, but a checklist of things that you can have a look at. I don't think any of these things are too difficult to have a think about, but if you start putting all the companies you're interested in through this checklist, hopefully by the end of it, you'll just have better companies that you're looking at investing in. You might think a company is really good, and then you really think about all of these things and you say, actually, the company isn't too great. So you can see the Tattooed Chef came out with a score of around 70. That's a really good high score. For me, that means the company is investable, plus the company is really new and a lot of these scores could change in the coming quarters. Now, I really hope you guys found this useful. I know that it was a really long one, so for all of you who made it through to the end, thank you and well done for sticking through to it. I really hope you found it useful. You guys know on the channel, I'm really trying to bring you value. It's not just about views, it's about trying to give you guys something that can be used by you guys to action your own research. I know a lot of people will just tell you that this company might be a good investment or that company might be a good investment, but I really was empowered when I found myself able to actually research companies for myself, because in that way, if no one on YouTube was talking about a company I was interested in, I could still do the research and assess whether that company was a good investment and decide that for myself. And I found that really empowering, and I really want you guys to be able to do the same as well, and maybe then come along and share those ideas that you come across with the rest of the channel. Now, I know that all of the stuff on here was a lot to go through, so I am going to offer to give you guys the link to this spreadsheet so that you can use it for yourselves. Just download it, make your own copy, use it for yourselves, and do what you need to do with it. So if you guys do want a link to the spreadsheet, if you want to have access to it and you want to be able to edit this and use it for yourselves, then just let me know in the comments below. If I get a lot of comments that are asking for it, then I will upload it and put it as a pinned comment so you guys can access it. But anyway guys, I really hope you found it useful. I really hope you found it helpful. If you did, you know, all I ask is that you smash that like button, hit subscribe, consider joining the Foolish Investing family. If you enjoy content like this, if you want to learn while you watch and learn how to invest, as well as just kind of hearing my analyses on companies, then do consider subscribing, join the Foolish Investing family. We'd really love to have you, and do hit that notification bell as well so you get these updates when I release this kind of content. But until next time, do take care, and I hope to speak to you all again.